Welcome to the debate.
It's good to be here.
Today we are dissecting a company that really seems to exist in two parallel realities. Depending on who you ask, NIO Inc. is either the next global tech giant poised for a massive valuation re-rating, or it's a cash incinerator running on borrowed time and some very optimistic accounting. It is Thursday, January 29, 2026. We are looking at a company that just delivered a record-breaking 144,807 vehicles in Q4 2025. They've just launched NWM 2.0, a huge software overhaul, and they claim to be on the brink of profitability.
And that's exactly where the realities collide, isn't it? Because while the delivery numbers are, they're undeniably high, the financial mechanics underneath them are, let's just say, strained. So the central question we're wrestling with today isn't about how many cars NIO can put on the road, it's whether those cars were actually making money. Is NIO really achieving a structural inflection point toward a high-margin tech valuation? Or is this optimism about a Q4 break-even just a mirage masking the fact that the easy money, the subsidies, is gone?
Well, I'll put my cards on the table immediately. I believe we are witnessing a fundamental metamorphosis. For 12 years, NIO was a capital-intensive manufacturer. Today, in 2026, they are entering what I'd call a harvest period. The infrastructure is built, the R&D spend has been structurally lowered because, the heavy lifting is done, and most importantly, the revenue is diversifying away from just metal and rubber to high-margin software, silicon, and energy services. The market is starting to re-rate this stock from an auto manufacturer to a tech platform.
The execution gap. We've seen promises of profitability before, but now we're facing a subsidy cliff that hit back in October 2025. The government isn't helping sell these cars anymore. I see huge overhead costs, a frankly confusing multi-brand strategy, and a tech valuation that feels premature. Until I see the audited ink on the Q4 numbers showing real profit, not adjusted profit, I have to remain the skeptic.
If you look at Q3 2025, we saw the green shoots, positive operating cash flow for the first time in the year. Gross margins jumped to 13.9%, which is the highest in 3 years. But Q4 is the clincher. They hit the high end of guidance with that roughly 125,000 delivery number. And here is the key takeaway. It's not just volume, it's the mix. The growth is being driven by the ES8, their flagship SUV.
Which is their most expensive car.
Exactly. The ES8 commands margins north of 20%. So when your volume driver is also your highest margin product, you have a massive lever for profitability. Management is confident in non-GAAP profitability for the full year 2026 because of this mix, supported by the new tri-brand strategy, NIO for luxury, Envo for the family market, and Firefly for the entry level.
You see, you mentioned the tri-brand strategy as an asset, but I view it as a liability. This brings me to my counter-thesis. The market is ignoring the operational drag. You cannot launch two new brands, Envo and Firefly, simultaneously without your SG&A just exploding. That's selling general and administrative expenses, basically the cost of running the business. Analysts from CMB International are predicting a net loss of 1.6 billion RMB for Q4. That is a direct contradiction to management's break-even claim.
But that forecast ignores the efficiency gains and the specific levers they're pulling to manage those costs.
Does it? Or does it reflect the reality of logistics? You can't expand into 20 global markets with Firefly without hiring people, renting space, and shipping metal. That burns cash. And furthermore, look at the demand side. The trade and subsidies ended in October. That was a lifeline for the mass market Envo models. If that volume dries up because the car is suddenly 15,000 RMB more expensive, your factory utilization drops and your margins get crushed.
I think you're looking at the expenses through a 2024 lens. Let's break down the feasibility of this Q4 profitability because the math has changed. You mentioned margins. In Q3, vehicle margins hit 14.7%, partially because material costs dropped. Lithium is cheaper, aluminum is stable. But the real story is the organizational optimization. That's corporate speak for we cut the fat. They reduced personnel costs significantly. They are targeting an SG&A to sales ratio of 10%.
Okay, but 10% is incredibly aggressive for a company in expansion mode. Tesla sits around there, sure, but they aren't launching 2 new brands this year.
But NIO isn't building traditional dealerships for Firefly, which cuts that cost down massively. We can get to that later. The point is, they aren't operating on fumes. They ended Q3 with nearly 37 billion RMB in liquidity, bolstered by that $1.16 billion equity raise in September. They have the runway to optimize. The path to break even isn't about selling 200,000 cars anymore. It's about selling 125,000 cars efficiently. With the ES8 driving the weighted average selling price up, the revenue per unit is climbing faster than the cost per unit.
I will concede the cash position is better than, the dark days of early 2024. However, you're glossing over the subsidy cliff. That trade-in subsidy wasn't just a nice bonus. For the Onvo L60 buyer, who is very price-sensitive, it was the deal maker. If Onvo volume softens in Q1 2026, which is historically a slow quarter anyway, that whole narrative of efficient growth just falls apart. You can't have high margins on a factory line that is running at 60% capacity.
That is a valid risk, but that is exactly why the second pillar of the bull case is so vital. We need to stop looking at NIO as just a metal bender. We need to talk about the silicon. The re-rating of the stock isn't coming from selling more bumpers. It's coming from the chip division. This is where the valuation model shifts from car company to tech company.
And this is where I struggle the most. CEO William Li famously said developing the Shenji chip cost the equivalent of building 1,000 battery swap stations. I mean, that is billions of RMB in sunk costs. It feels like a vanity project. Why build your own chip when you can just buy NVIDIA Orin chips like everyone else?
Because owning the silicon turns a cost center into a profit center. The Shenji NX9031 isn't just a generic chip. It is a 5-nanometer process beast with 50 billion transistors. For the non-technical listeners, 5 nanometer refers to the size of the transistors. Smaller means more power and less energy consumption. 50 billion transistors is triple the density of the standard NVIDIA Orin X.
Impressive specs, sure. But does it pay the rent?
It pays the rent in 2 ways. First, margin protection. By using their own chip, they save roughly 10,000 RMB per vehicle in the bill of materials. That's about $1,400 straight to the bottom line on every single car. That alone justifies the R&D over time. But the real game changer is the external revenue.
You mean licensing?
Exactly. They spun off the chip division into a joint venture with Axera and OmniVision. They are now licensing this IP to other automakers and robotics companies. This allows the market to view NIO through the lens of a semiconductor IP model. Think of companies like Cadence or Synopsys. Those companies trade at massive price-to-earnings multiples, sometimes 40x or 50x, whereas auto manufacturers trade at what, 5x or 6x? If NIO generates even modest revenue from licensing, the stock price implications are huge because that revenue is almost pure profit.
IF is doing a lot of heavy lifting there. The semiconductor IP market is brutal. You're competing with established giants, and let's be honest about the auto industry dynamics. Would a direct competitor like XPeng or Li Auto really buy a core autonomous driving chip from NIO? I doubt it. They'd view it as a strategic vulnerability, so your market is limited to smaller players or robotics. I am skeptical that licensing revenue will be significant enough in 2026 to justify a tech multiple re-rating.
It doesn't need to be XPeng. The robotics sector in China is exploding. But even if we put the licensing aside, the chip enables the software. And that brings us to yesterday's news, the NWN 2.0 rollout.
The world model. Right. I've read the white papers on the cognitive shift.
It is more than just a buzzword. This is the Banyan 3.3.0 update. Until now, most self-driving systems used imitation learning. Basically, the car watches a human drive and tries to copy the behavior. If X happens, do Y. The NWM 2.0 NIO world model is a generative model. It uses a Code 3.0 paradigm.
Explain Code 3.0 for the audience.
So Code 1.0 was manual rules. Stop at a red light. Code 2.0 was learning from data. I see a red light, I've learned to stop. Code 3.0 is outcome scoring. The car simulates 216 potential future scenarios in 100 milliseconds. It imagines parallel worlds.
If I swerve left, what happens? If I brake, what happens? It scores the outcomes and then chooses the safest path. It essentially imagines the future to navigate the present.
It sounds like science fiction, and frankly, that's my worry. The parallel worlds concept is academically fascinating, generating 120-second video simulations from 3 seconds of footage to train the car. But does it work in a Beijing traffic jam today?
The early data suggests it does.
The early data? But let's remember the mid-2025 rollout of NWM 1.0. The feedback was mixed at best. Users felt the car was overly cautious, hesitant at roundabouts. It felt like a student driver. Tesla's FSD is out there with millions of miles of real-world aggression. Huawei's ADS 4.0 is known for being assertive. My concern is that NIO is just using fancy terminology to play catch-up. If the system is hesitant, premium buyers won't use it.
That hesitation was part of the safety calibration. Banyan 3.3.0 changes the behavior because it understands why a human makes a move, not just what move they make. And unlike Tesla, NIO has the sensor redundancy of LiDAR, that laser radar on the roof. This is essential for the 2026 product roadmap. If they can prove this system is safer and smoother, that's a massive differentiator for the premium buyer they are targeting with the ES8 and the upcoming ET9.
I will be watching the disengagement rates very closely. If the car has to hand over control to the driver in complex urban scenarios, then the world model is just a marketing term. But let's pivot to something more tangible, the physical assets, the batteries.
The Power Swap Network. This is the ultimate moat.
You call it a moat, I have often called it an anchor. It's expensive real estate, but I am willing to look at the new data regarding V2G.
Vehicle to Grid, or V2G, is the hidden unlock. NIO has over 3,700 swap stations now. In the past, these were cost centers, places where NIO paid for electricity. Now, they are becoming a distributed energy utility.
How does that actually translate to the stock price in 2026, though?
It's about recurring revenue and defensive positioning. Analysts at Macquarie upgraded the stock to outperform largely based on this. Over 80% of customers choose battery as a service, or BaaS. They don't own the battery, they rent it. This shields NIO from battery price volatility. But with V2G, those batteries sitting in the swap stations can stabilize the grid. They buy electricity at night when it's cheap and sell it back to the grid during peak hours when it's expensive. It turns the battery from a depreciating asset into a trading tool.
The utility model is interesting, I admit. It smooths out the revenue lumpiness of selling cars. You sell a car once, but you trade electricity every single day.
And there's a consumer incentive angle that buyers often miss. The BaaS model, where you rent the battery, strips the battery cost out of the vehicle purchase price. This actually lowers the threshold for tax exemptions in several regions. So the car becomes cheaper for the buyer, they pay less tax, and NIO gets a recurring revenue subscriber for life. It's a financial loop that Tesla or BYD simply doesn't have.
That is clever engineering of the tax code, I'll grant you. However, I want to bring this back to capital efficiency and the international expansion. Because you can have the best grid tech in the world, but if you burn too much cash expanding Firefly into Europe and South America, you go broke.
This is where they learn from their mistakes.
Well, they had to. The direct sales model in Europe, building those fancy NIO houses in Berlin and Oslo, was burning way too much cash. Now they are shifting to a partner model for Firefly. They're working with local distributors.
Correct.
It reduces risk, yes, but it also reduces margin capture. When you use a dealer, you have to share the profit. You lose control of the customer experience. Doesn't this dilute the premium brand equity they've tried so hard to build?
I argue it protects it. Firefly is the mass market entry point. It's a volume play. Using partners allows for rapid, capital-light expansion into 20-plus markets in 2026. They can't afford to build a direct sales network in Brazil or the UAE right now. They need volume to feed the ecosystem. Even if the per-unit margin is slightly lower due to the dealer cut, the return on invested capital, the ROIC, is higher because NIO isn't paying for the real estate.
And what about the swap stations for those global markets? You can't sell a band's car without a place to swap the battery.
That's the other side of the partnership coin. They aren't just partnering on sales. They are partnering on infrastructure. They've signed deals with local energy providers and other auto groups to co-invest in the swap network. It cuts the CapEx burden in half. This strategy allows them to capture market share without destroying the balance sheet. It's the smart play for the harvest period.
It is the necessary play. I'm not sure I'd call it the smart play if they had infinite capital, but they don't. It is a concession to reality. And, looking at the broader picture, Morgan Stanley sees 52% upside for the stock. They're looking at the convergence of all these factors: 20% vehicle margins, recurring BaaS revenue, chip licensing, and the NWM 2.0 rollout. They see a company that has survived the cash burn phase and is now ready to scale profitably.
Exactly. The pieces are all there.
But CMB International sees only a 17% upside and remains cautious on profitability. The divergence in analyst opinion is telling. The bulls see the tech, the bears see the expenses, and frankly, the bears have been right about the timeline for the last 3 years.
But even the bears are raising their targets slightly or holding steady. No one is predicting a collapse anymore. The debate has shifted from will NIO survive to how profitable will NIO be. That shift in sentiment is the inflection I'm talking about.
That is a fair assessment of the shift. But let's wrap this up with our final outlooks.
For me, 2026 is the year of vindication. The Q4 2025 numbers hitting 125,000 deliveries and likely hitting break-even are the proof of concept. The chip licensing proves the R&D wasn't wasted. The V2G network proves the infrastructure pays for itself. The stock is being re-rated because the business model has evolved from a heavy manufacturer to a tech-driven ecosystem. If you're looking for a company that combines the manufacturing capability of a legacy auto giant with the software margins of a Silicon Valley firm, NIO is positioned to be that player.
And I remain the voice of caution. NIO has survived the cash burn phase, yes, but survival is not the same as success. I suspect the Q4 break-even target will be missed, narrowly perhaps, but missed, due to those sticky SG&A expenses and the subsidy cliff impact on the Envo line. The company is currently valued on future promises, chips, AI, V2G, rather than the current reality of selling cars in a difficult subsidy-free environment. Until I see the other sales revenue line in the audited report actually reflecting significant chip licensing income, I view the tech valuation as speculative.
And that is the beauty of the market. We will know the truth soon enough when the audited results drop.
Indeed. And for our listeners, I'd suggest you look closely at that other sales line item in the next report. That is where the truth about the tech monetization will be hiding. Don't just look at the headline number.
Absolutely. Whether it's a mirage or an inflection, it is certainly going to be an interesting year for NIO.
It always is.
That's all for today. Thanks for listening to The Debate.